Welcome to the Molding Live Show, where we tell the amazing stories of everyday people that are committed to building a better life for themselves and those around them, and in turn, build generational wealth. In this episode of the show, we speak to Kanwal Sarai about being a dividend investor and his journey as a SaaS founder. Kanwal Sarai, welcome to the show. Thanks very much for doing this. We're really glad to have you on board.
Thank you for having me, Oliver. I'm happy to be here.
Yeah, I've been thinking about it for a while, but I know I only approached you probably about a month ago. My brain just kind of works that way. But really glad to talk about this topic because I think anything financial, I do have quite an interest in it. But we're talking about dividend investing, which is quite an interesting concept. And, we're going to unpack why you went into that and why you specialize in that and everything like that. But maybe just to kick it off, if someone was meeting you for the first time, how would you introduce yourself? What's your elevator pitch?
Sure. I would introduce myself. I've done many things. I'm also a father. I've got 2 kids. My background was in computer science. Graduated in 1996. Started working, have been working since then in the corporate world, and then left the corporate world in 2019. So the elevator pitch for now, I am the founder of Simply Investing. I teach people how to grow their money, how to take the money that they have and increase it. And we do that through dividend investing and focusing on quality dividend stocks when they're priced low. So that's the elevator pitch.
Yeah, and I think the terms, like dividend investing, I want to go into that. So if anyone's not familiar with that concept, and what I loved about your story, I think we met, because we're in the same mastermind group, and so it's over a year now, I think. But I've always been interested in the story because in many ways it seemed to mimic my story, in terms of leaving corporate. I think we seem to be about the same age group as well. And so I'd love to unpack that, why corporate, why did you leave corporate? But before I do that, just in simplistic terms, what is dividend investing?
Sure, that's a good question. So quite simply, a dividend is the company sharing its profits with you, the shareholder. So I'm going to give you a really quick example. If let's say a company is paying $1 a dividend per share, okay, and you own 1,000 shares. So you will receive $1,000 every year in cash as long as you own those shares and as long as the company continues to pay the dividend. So you can spend that money if you wish, or you can reinvest it, right? So the dividend is and it gets deposited immediately, electronically. These days, you don't have to wait for a check in the mail. It gets deposited directly into your stock trading account as cash. And again, you can spend the money if you wish, or you can reinvest it. So that's sort of in simple terms what a dividend is.
Yeah, and I think what I like about it is the fact that you don't lose the capital. You haven't lost it. It's just almost like you've got it, you own it forever, and as long as you want it. And then every year you just get this check. And I suppose in many ways it's like a fixed deposit or any type of savings, but I suppose the difference is the returns are probably better. And I think the way you do your amazing stock selection as well is based on rising dividends. So every year, it obviously gets better. Is that correct?
Yes, absolutely. And that's a good point you just made there, Oliver. You don't need to sell any of your shares or your stock that you own. So going back to the original example, if you own 1,000 shares, as long as you hold on to those shares, you're going to keep getting dividends as long as the company's paying the dividend. So there's no need to start selling your shares. Without the dividend, then you're hoping for the stock price to keep going up forever. And then when you need money, you have to sell those shares. And that's what I like about dividends is exactly what you said. You're not having to sell your capital. Now, let me give you just 2 examples here. And before I get to the 2 examples, I do want to mention one more thing. The dividends will keep coming in regardless of the stock price. So if I was to buy the shares today at $30, tomorrow they drop to $20 a share, it doesn't matter. The dividend, and if it's $1 a dividend per share, you're going to get that dividend as long as you own the shares. The stock price can go up and down. And we see that. The volatility in the stock markets in the short term, prices go up and down all the time. And so that's the beauty of dividend investing, is that we're not impacted by the stock price. Now, let me give you two examples. So everybody knows Coca-Cola. It's an international brand.
Yep.
Coca-Cola has been paying a dividend since 1893. So I'm going to say that again, has been paying a dividend since 1893. That's 129 years.
Yeah.
Okay. An even better stat is that Coca-Cola has been increasing its dividend consecutively for 59 years.
Wow.
Think about how many recessions we've had in the last 59 years, how many market downturns we've had. But companies like this, 3M is another one. They're now more famous with building the masks, the N95 masks, the Post-it notes. So 3M is another international brand, and they've got 63 years of consecutive dividend increases. So when you look at companies like this, it gives you some degree of confidence, at least it gives me confidence, that they're going to keep paying me a dividend next year and hopefully increase it again next year. And so every time the company increases the dividend, that's more money in your pocket.
Okay, that's actually amazing, and that's why I love what you're doing, because essentially, I think lots of people don't know this. I mean, lots of people know the stock market, and I think the problem with the stock market, in my mind anyway, it seems very much like gambling, and like it's you don't know what happens, and I think there's amazing people, and I think you refer to obviously like people like Warren Buffett. I mean, they've obviously changed the game for us in terms of stability and how you can probably make money. But I think for the large part, most people, they get into the stock market, they figure that the money that they should be making is on the increase in the shares. And, and what you just said now is important, is that just like with shares, you only lose once you sell. And most people, they sell and then they either win or they lose in terms of profit or loss. But your strategy, around dividend investing is you don't ever lose if you pick the right stock. You always get that money. And like you said, like 59 years, one would hope that you get your capital back at some point, in terms of the money that you spent on the shares. So yeah, it's a really, really cool strategy.
Absolutely. And let me give you a quick example with Walmart. So Walmart has had 48 years of consecutive dividend increases. Okay. If you had purchased, this is an extreme example, but if you had purchased 100 shares in Walmart, okay, total investment would have been $1,650 at the time. Okay. This is going back to the early 1970s. I believe they had an IPO in 72 or 73. So if you had purchased 100 shares in Walmart and just held on to it today, and I don't have the exact, I can get the exact number for you later, but today you would be receiving over $400,000 a year in dividends. That's US dollars.
Wow.
That's almost $500,000 of dividends every single year. And you didn't have to sell a single share. You just had to hold on to it. So that's the power of dividend investing.
I hate those examples, by the way, because it always makes you like, oh, I should have done that. Because whenever I know why we do it, and I love the story, but it always gives you this like feeling of regret. I should have done that. It's like 20 years ago, I wish I did that. But what I like about how you've even transformed the I want to say the industry, but like we're going to go into your your software product, but right now, at this minute, you can still predict what that could be, based on stocks that you can pick. And I think that's pretty powerful. And I think, just to close it off, and the reason I like it, I don't use it, to be honest, but it's always been at the back of my mind. I subscribed to this financial newsletter many years ago, and they spoke about it, because if you get your regular income supplemented or get dividend income to be what your regular income is, you're pretty much retired. That is a strategy. It's the same like rental, or real estate. If you can get your real estate income, to be the same as your monthly disposable income, you're pretty much retired. You don't have to work ever. The difference, though,
absolutely.
Sorry.
I was just going to add to that, Oliver, exactly what you were just saying. Just to put it in sort of a different set of words, as soon as your dividend income can cover your living expenses, your day job then becomes optional.
Hmm. Yeah, I like how you said optional. I think for most people, it would be definitely, I'm not doing it. But yeah, I like that. And then I suppose, I mean, I was going to go with a train of thought, but let me get you to answer it. Is why not real estate income though? Because I mean, that would be, because
Mhm.
I suppose everyone advocates for that, and I think you going with a similar strategy, but not real estate.
Mhm.
So I think everyone understands the real estate stuff. So the
Yeah.
question is, why not real estate?
Sure. And I'm going to add to that. Why not starting your own business? Or why not owning a restaurant or a franchise
Mm,
restaurant? So I looked at all of those things, right? So working in the corporate world, I worked with fantastic people. The job was good. And we can talk about it later, I think, if you want to get into more of why I left my work.
no,
Um,
definitely.
so we'll get into that later. So having to answer your question about real estate versus stocks, my dad owned a number of properties when we were living in Montreal. He owned 3 different rental units, and he owned a fourth property with a friend of his, 50% ownership. And every weekend we were going to the apartments to mow the lawn, cut the grass, do some landscaping. Every time a tenant left, we had to repaint the entire unit. A lot of tenants would not leave the place in a clean, we'd have to clean everything up. So there was a lot of time and effort dedicated to maintaining the real estate properties, right, to earn that rental income. So it wasn't truly passive income. Now, I know some people nowadays, they're big on property managers, they could hire someone to take care of that. But we were getting calls at 2 a.m. because the toilet didn't flush anymore, right? And somebody wanted that fixed right away.
Yeah.
So either, and in my case, we had to go there ourselves and to get that fixed. Nowadays, perhaps you could have a property manager to do that. What I like about stocks is it's truly passive income, right? I'm going to give you a quick example. I know the Walmart example was extreme, so I'll give you a more recent example. I bought TC Energy, 185 shares in TC Energy, for a total investment of $2,479. Okay, so that was back in 2001. Since then, I've received over $7,500 in dividends. So my capital is completely covered. I bought the stock at $13 a share. I think it's like $55 or $60 a share today. I haven't looked at the stock price today.
Mm-hmm. Mm-hmm.
But do I care if the price drops tomorrow to 30 or 25 or even 10? No, I've more than made up my money, almost more than doubled, obviously more than double the money. So the risk with dividend stocks, your risk goes down. Every time you get a dividend payment, your risk goes down. Every time the company increases the dividend, your risk goes down.
Mm-hmm.
And over time, your risk will be zero because you'll have made all your money back. In the case of TC Energy, when I bought it initially, the dividend yield was 5%, right? So you take the dividend divided by the share price, that's your return on investment while you're holding on to the shares. So it was 5%. Today, dividend yield based on my purchase price is 26%.
Wow.
So I'm now earning 26% on my initial investment, which was $2,479.
Mm-hmm.
So you can do the math. So 26% of that comes back to me in cash every single year. And next year, it'll be about 27% because the company has been increasing dividends every single year since 2001. So those are the benefits of dividend investing, which I don't see that with real estate, but there's nothing wrong with it. I mean, I have clients who own rental properties and making real estate income, and they're making dividend income as well, right? So you can do that. And you can also, probably I don't want to get into it now, but starting your own business or getting a franchise. But then you're dealing with employees and you're dealing with staff. So it's, I love stocks because I don't have to do a lot of work. The example with TC Energy, it was about 15, 20 minutes of work back in 2001 when I ran through my sort of the 12 rules of simply investing. And I made the investment. And since then, I have not had to spend any more time on that investment at all.
Okay. Yeah, I love that. I'm with you, by the way. I mean, I tried real estate, and for the same reasons that you just said now, with your dad, and the amount of work that you had to do for it. I mean, at one stage, I think we had about 10. We didn't cover this, but you're based in Canada. I think for anyone that didn't pick up on the accent, but in South Africa we had that property, and I remember it was the one weekend, and we had our little our daughter, and she was probably 1 or something, and I got this call from this tenant, and he was like, the geyser burst, and it's one of these complexes, or townhouses, flats, and I was like, just call out the plumber, and obviously I'll pay for it. And he refused to do it. He was like, no, but I need you to come out right now. And it was like a 30-minute drive, and I got there, and obviously I'm not a plumber, so I don't know what to do. So I called out the plumber, and it was just as easy as that. And I tried property managers, and it just never worked. And that weekend, I got back from that, and obviously solved the problem with the plumber. But got back, and I told my wife we're selling all of them, and now I don't do that. I mean, I just don't have the time, and I think that's what it came down to. It came down to time, and I think what you said was very, very important. Is that how much time does it take? And most people, when they say passive income, it's not really passive. You spoke about the business as an example. Business is not really passive income. It's probably active, unless like if you get that model perfectly right, and there's no support tickets, and the software is stable maybe, and you don't have any employees, maybe you could do that. But for the large part, I haven't come across a strategy as solid as your one around dividend investing. If you want to purely like stress-free, just get the money at the end of the year kind of thing.
Absolutely. And the dividends interest, your audience may or may not know this. So I've been doing this for 21 years. So for me, it's just intuitively, and I just kind of skip over some things. But the dividends in my case, and in all of my clients who have a portfolio, once you have a portfolio of 15, 10, 20, 30 stocks, I get paid almost every day. Every day, some stock is paying me a dividend. So there's monthly income now. So it's not having to wait for a year. There's monthly income, like in my case, every week, there is always income coming in. So you don't have to wait for a whole year to get the dividends.
Okay. I actually didn't know that. That's actually an interesting point. But it obviously depends on, when the financial year ends out for each company, and then when they declare the dividends.
So again, Oliver, in the large companies, the large international companies, I'm sure it's the same in South Africa. I know in the UK, in Canada, and the US, all of the large international companies, they are paying every quarterly. The dividend is paid out every quarter, right? Okay. And so if you've got a portfolio of 30 companies, every month somebody has a quarter ending, right? Okay. It's their financial quarterly dates, whatever that is. So.
That could be a strategy on its own as well, because obviously you want the regular income. It's almost like picking that and knowing when that income is going to come in. I mean, like that's pretty exciting. And I think before we move away from the point, I think this point is quite clear as well. Is that you mentioned a story with TC Energy, and I think that's a really cool story. And when you bought it in, but I think for anyone that wanted to model that disposable income that they needed. Right now, the only difference is how much of capital you want to put in. You bought it at obviously a lower price, but if I wanted to mimic that same level of income, obviously I would have to pay a lot more for the capital investment in, but I could still mimic that disposable income. And I think that's quite powerful as well. You could almost like buy the future earnings right now, if you wanted to. And I think that's,
you've got enough capital.
Cool. Yeah. And I think that's
absolutely. Cool. Yeah. Now, I want to mention for your audience as well. So this approach is it's a long-term investing approach, right? So I don't talk about day trading. I don't advocate day trading because it's very time-consuming, and you have to know what you're doing, and you may or may not succeed. But from my point of view, again, a lot of my clients are in the same position. You're working full-time. You have kids. you're married or you're not, but you're busy. And especially with kids, it's every day there's swimming practice or soccer and basketball, football, and all this stuff. And so you don't have hours and hours to spend every week looking at your investments and trying to figure out what to do, right? So that's one of the good things about this approach is it's very much hands-off. It's a long-term approach. And so there's two things that you need to be successful. Number one, you need money. The more money you have, the more success, the more money you'll make. Cool. That goes without saying. But the second thing is time. And what I advocate, the more time you have, the more time you stay invested in the market, the more money you will earn. And so my ideal client are in their 20s, right? If I can talk to you while you're in your 20s and 30s, fantastic. And this is why I love teaching children, right? I've taught a number of classes at the high school level. So this would be between 13 and 14, 15 years of age. I think my course should not even exist. My course should be taught at every single school. So kids get that education from day one, right? But they don't teach that. They don't teach it in America. They don't teach it in Canada. I'm sure it's the same where you are. So I developed my course and I started teaching it. So here's the thing. If you don't have $100,000 today to invest, start with what you have, right? And I didn't start with $100,000. My first stock purchase was $500 and that's it. Okay. So that was 21 years ago. That's all I started was with $500. And then you build on it. And as the dividends start coming in, I now take those dividends, which is free money. I'm putting that in quotes. It's just money that they give to you for holding onto their shares. So I take this free money and I buy other dividend stocks with it. And now you see they're paying me dividends. So it just becomes a snowball effect and you start earning more and more and more. The example I gave you with TC Energy, where I said that I've received over $7,500 in dividends, that's true. That's $7,500 in dividends from TC Energy. But over the last 20 years that I've owned the stock, I've taken their dividends and I've bought other stocks with it that have paid me dividends. So I probably made over $10,000 in dividends collectively from other stocks. Amazing. Yeah. Right? So you do need time and you need money. If you have both, fantastic. That's even better. But if you don't have a lot of money, you got to start sooner than later. Right. And in my case, I wish I started this 15 years earlier. It took me a while. I started in 99 and 2000. I wish I had started 15 years earlier than that.
Yeah, I think that's always the thing. And as we get older, it becomes more and more of a problem, where you always think, okay, I wish I knew this in my 20s. I wish I knew this, before I finished school and things like that. But yeah, it's always like an immaterial thing. But I want to ask you how you came up with the idea, because I think that would be an interesting story. But just to finish up on the returns thing. So in South Africa, I mean, the rate, we call it the repo rate, which is basically the bank lending rate or the prime lending rate. Just to put in perspective, with those returns that you're speaking about, what's the prime lending rate or the average rate, interest rate that a bank would give you in the US and Canada?
Sure. So in the US and in Canada today, a savings account or a checking account at the bank, horrible. I think the interest rate is 0.1% or 0.2% annually, right? So you put $1,000 in, you're going to get 0.1% back as in interest. Terrible. Then we have what we call term deposits. So you put your money at the bank, you lock it in. So if you lock it in for a year, you might get 1%. If you lock it in for 2 years, it'll give you 1.5. If you lock it in for 3 or 5, a 5-year term deposit today in Canada is probably about 2%, and that's it.
Wow.
Right? But then your money's locked in for 5 years. You cannot take the money out, but the bank will give you 2% every year. And at the end of the 5 years, you'll get your money back plus the interest. Right? So the interest rates are dismal. Which is why I like dividend stocks. I can give you a couple of examples in Canada, especially with the large 5 banks. The dividend yield today, which is the return on your investment, is about 4.5%, 5%. Right, so you could make 5%, which is great. There's some stocks that pay 6%. There's even ones that pay 8 or 9 or 10, but that's a different story. And I don't recommend those.
Okay.
That's what we call the dividend is in danger, right? It's too high.
Mm.
So generally today you can anywhere from 3.5, 4, 5% return.
Mm.
Okay. Every stock is different, right? They all have different dividends that they pay. They don't all pay the same amount. Some companies will pay you $1 a dividend. Some will pay you $1.25. Some will pay you 36 cents. So the dividend amount varies, but you can look at getting around 3.5, 4, even 5% return today. But
Okay.
remember what I said, as those companies increase dividends every single year, your rate is going to go up over time. And so I have stocks today. I gave you the example with TC Energy is 26% return. I have a lot of other stocks. More than half of my stocks are now returning in the double digits. So 10, 11, 12, 14% every single year.
Yeah, that's amazing.
But it takes time to get there.
Yeah, I was just going to say, so in South Africa, I mean, you know, the prime lending rate is a bit higher, but obviously it's an emerging economy or developing country, and the inflation is a lot higher than it is in the US and Canada, and that obviously has an impact. But you know, like I think it's still not, you're not buying into, you know, it's obviously just a deposit. But in this case, and I think, you know, like I don't know if you factor that into your model or not, but it's not just that the fact that you have that capital at $1,000, but that capital actually could go up in terms of capital appreciation, you know, of the stock price, because that's a secondary. I know that's not part of dividend investing, but I mean that is a secondary benefit, you know, of that. You mentioned TC Energy, you know, in terms of the stock, you know, the share price. So you've actually increased your portfolio, you know, or the wealth part, just by holding onto the stock anyway, and you're getting the dividends, you know, for the privilege. So that's pretty amazing.
Absolutely.
Yeah,
that's a good point.
Whereas if you had to put it in a bank, I mean, you're not going to increase the $1,000. You know, like that's, you know, you're just going to keep your $1,000.
Yeah.
Okay, cool. So where did the idea come from? I mean, it must have been some moment that you thought, was it the rental part? You know, like when you decided you're not gonna clean any more properties.
So a good question, Oliver. So my story begins at around 98, 97, 98, sort of 99, when I started. So I originally from Montreal, moved to Ottawa in 99. Ottawa is the capital city in Canada. My wife and I moved here in 99. I started working. I don't think I'm cut out to be an employee. I don't know if I should say this publicly to the world, but it's too late. I've already said it. Because I've spent 24 years working in the corporate world. Okay, my background is computer science. In the last 24 years, I've worked at probably 7, 8, or 9 different companies throughout my career. I started in software testing, QA, quality assurance. I did pre-sales support as well. I love presenting, so I did a lot of sales presentations. Worked as a consultant, worked as a professional services manager, where we build custom features for clients. And then most recently, it was a QA manager, right? So I was managing a team of, at one point, I think I was up to 14 people, 14 direct reports, managing that. Okay, I want to get back to your question about how this all started. So, you know, I'm working, the pay is good, the people are good, the work is interesting, but after a while, I'm like, I don't see myself working in a cubicle, like an office with 4 walls, for the next 45 years. Because I looked at people who were 10, 15, 20, 30 years older than I was, and they were still sitting next to me doing the same job. And I said, it's not for me, right? It's for some people enjoy that. It's the same work day in and day out. I think it's great. If you enjoy that, then keep doing that. But for me, I couldn't see myself doing it for another 45 years. You know, my dad worked at the same company for 48 years, right? And that was back in the day. But I was like, I got to do something else. I got to figure something else out. So I started researching, like you said, I looked at real estate again, right? I said, maybe I can do it differently than what I do with my dad. Maybe I can automate it and, get the property managers and all that stuff. But I crunched the numbers. I like putting numbers together on Excel spreadsheets and just crunching the numbers, and it just didn't make sense. And it required, the initial investment was higher, right? I didn't have $100,000 cash lying around, right? Especially in '99, just having graduated from school 3 years earlier. Because people say, oh, well, you can buy a property and you only have to put 5% down or 20% down.
Yeah.
So that's still a lot of money. So I didn't have the cash. I looked at starting a business, same thing, requires a lot of capital. Didn't have the cash. And looked at some franchises. Also, numbers didn't make sense in the amount of money you'd have to spend. And then fast forward a couple of years, my son was born. So here's the story. He's a newborn. He was waking up like every hour. He knows the story. We've told him the story.
Okay.
Now and it was hard for me. That's right. It was hard for my wife and I with a newborn. He's waking up often, all this stuff. So the only way to get him to sleep was to hold him. So I had this sort of, it looked like a backpack, but you wear it in front of you and you put the baby in it. So 2:30 in the morning, I'm holding him and I have to walk, I just have to walk. I'm just pacing back and forth in my house. And as I'm doing that, and I'm like, well, I can be doing this for like an hour, maybe 2 hours. I need something to do here. And I looked at the bookshelf and there was a book from the Motley Fool. I think it's called You Have More Than You Think. I picked up that book and I just started reading it at 2:00 in the morning while I was holding my son. Wow. And in that book, they talked about dividends. I had no idea what a dividend was. Never heard of a dividend. Never heard of Warren Buffett. and so in that book, he's talking about dividends and, hey, the concept was shocking to me that you could own shares and someone's going to pay you. Does that even make sense? Someone's going to pay you for owning shares, right? And I was like, how is this even possible? Anyway, that book led to another book, which led to another book. Then they talked about Warren Buffett. And I said, who is this guy? I got to learn about him, which led me to Benjamin Graham. Benjamin Graham was Warren Buffett's mentor and teacher at Columbia University. So everything that Warren Buffett knows, he learned from Benjamin Graham. So I read his book called The Intelligent Investor, which was published, I believe, in 1938, 39. It's a good book. I don't recommend it for beginners because it's about this big and it's very technical.
Okay.
But what's shocking is what he talks about, even back then, the same things we're seeing happening today. You just have to replace it. You got to replace, when he talks about the railroads, just replace that with Bitcoin and just keep reading, right? It's the history repeating itself over and over again. And so anyway, so that's how I got started. It took me about 3 years of research, trial and error to start investing that way. I was scared to invest that way because I had heard a lot of horror stories about people losing their money in the stock market. So it seemed very risky to me in the beginning. And I kept all of my mutual funds and index funds and ETFs. I just kept them on the side. I said, if the stock thing doesn't work out, I still have my savings in here. So it was a 3-year process for me to transition from the mutual funds and ETFs and index funds to transition completely to owning individual stocks. And then once I figured it out, I love sharing information with people. So all of my brothers and sisters and my family and the in-laws, everybody has heard about the importance of dividend investing and the benefits of dividend investing. And so that's when I eventually, a few years later, I started teaching in Montreal, Ottawa, and Toronto. So I would do that about 3 times a year and just go around teaching. The entire course it's about half a day to teach. And then when our second child was coming along, I figured this is not going to be possible for me to go around traveling. And that's when I put the entire course online and made it available. And in the last 7 or 8 years now, we've sold in over 36 countries worldwide, where people can take the course anytime they want.
That is incredible. I think you just have to look at your website, and I mean, I know you've got a very, very active, YouTube channel, and even there, I mean, like it's amazing, So obviously that traction over many, many years, I suppose what you preach as an investment philosophy seems to be, how you do your marketing as well, because you're like over time it's built and built, which is amazing. And I think even just saying that, over 36 countries is incredible. Because I think the first time I heard your story, I was like, like it's interesting that you could carve out a niche, or even a story in the age where everyone seems to know Warren Buffett, and his philosophy. So yeah, well done for doing that, because that's amazing.
Yeah. Thank you. The other thing, I always want to keep it simple. I eliminate all of the jargon. Right. In 3 years, I've read hundreds of books, and some of them are good, and some of them not so good, where they go into so much technical terms that you almost feel like you need a degree in finance or accounting to figure this out. So I eliminate all of that. I like to keep things simple in life. So just plain English and just simple terms, and it doesn't have to be rocket science. And I think I told you, Oliver, I don't know if you remember last year, I said, it's so simple that a 9-year-old could do it. And I had both of my kids when they were 9 take the course. My son took the course accidentally because I left my computer on and while I was building the video modules. Yeah. And the next morning, it was a Sunday morning, we were having a waffle breakfast, and he said, "Dad, what do you think about buying stock in Bank of Montreal versus Bell Canada?" And what are you talking? Say that again. What are you talking about? And he said, "Well, I was last night, the day before, he said your computer was on, and I did all your modules. There was only 10 modules at the time, and he watched all the videos." Okay. And so that's how we got him started.
That's amazing. But he is kind of an overachiever, so that's actually a really cool story. I like that too. Off topic, but I mean, how did your wife handle you wanting to be this entrepreneur? Because I'm assuming, as you said, the money was good in corporate. People probably adored you, because I think if you can find people that communicate, that's normally a rare breed. And so you could communicate, you could be in front of clients, and you had all of that, but you still want to leave. And when you told your wife that, how was like, was she quite understanding?
So it was a long time coming. I had planned it for many years before I brought it up to my wife. So I had started the business, Simply Investing, while I had a day job, right? And at that point, we had 2 kids. And my wife was running her own yoga studio. And so I was the IT guy for that business. Okay. So imagine running 2 corporations, 2 kids, and a day job. So it was very challenging. So I'm not going to sugarcoat it and make it sound simple, because it wasn't. It was very challenging. Lots of hard work, many days where I would get up at 5 o'clock in the morning and get some work done before I had to go to my day job. Or at the end of the day, come home, help with meals, help with the kids' homework, put the kids to bed, and then I would work for another 2 to 3 hours on my business, Simply Investing. So it was a lot of finding time here and there, or when you take the kids to swimming class, right? So that's an hour class. Well, they're learning how to swim. I have my laptop open and I'm working on the business. So it took many years to work on the business. Had to get the, you know what? To me, it felt so risky to leave a day job to go out on my own, because with the day job, you're getting a paycheck. Right? You come into work, you're getting a paycheck. If you come into work and there's not much to do, you're still going to get paid because you showed up. So as long as you show up to work, you get your stuff done, you're going to get paid. So it was extremely risky to leave all that behind and start on my own, where you don't, now everything depends on me, right? So if I take a week off and I'm not doing any work, well, there's no income coming in, right? So we had to design it in a certain way. So I'm going to get to your answer right now, to your question. So what I did is I waited a couple of years, built up the business, looked at what our revenue was. When I got it close enough to what I was making at work, not exactly matching, but I figured I got it close enough where I know that if I was now to dedicate full time to simply investing, I know I could grow the revenue to where I wanted it to be. So that's when I had the conversation. And I mean, my wife was always up to date on where I was with my sort of revenue stream. And so we looked at where the business was. And at the end of the day, it was still taking a chance. I said, you know what? I'm going to try this for 2 to 3 years. If it doesn't work out, I can always go back and get a job somewhere. But we need to try this because we're not getting any younger. So it was something I wanted to do, right? Also emotionally, it was something that I had wanted to do for a very, very long time. Almost 15 years, but I stuck with the corporate job, and then we made a go of it.
No, that's amazing. I mean, I think you always have to respect that, and also, yeah. I mean, I think it's always challenging, from a family point of view. And I think when you have no responsibilities, and that's why I asked the wife question, because I'm actually quite envious of your story, because I had to I had to do like quite a few other businesses, just to get into that, and it was always the wrong businesses, the model was wrong and stuff like that. And my wife, like she was actually very understanding, I would say, in terms of that. But what I like about your stuff, I mean, it was very pragmatic. And you built one thing and you built it over time. So yeah, that's amazing. And I think also, I mean, like what you just said now, it's almost like this itch. You just have to do it, just to see how it'll work out. And I think that's the part. It's like until you did it for like 3 months or 6 months or a year, how do you know? And I think that was always the question in our mind until I could do it. It's like, how do I know if I should do this? And the way I did it,
I didn't want to have any regrets. Like, I don't know if you feel the same way, right? I just want to have any regrets, and I'm 85 years old and I look back and I say, you know what? I should have started the business, but I didn't. I ended up working for someone else for my entire life.
Yeah.
So I didn't want to have any regrets.
Yeah, I love that. I mean, I think the way I did it was because I did consulting. I would take like a break in between consulting projects. So you obviously build up a little bit of a buffer because, like you said, you don't pitch up, you don't get paid. So build up a buffer for 2 or 3 months, and do that more or less full time, and then try to move it along a little bit more. But it still wasn't the same as when I left completely, and then like almost got yourself completely immersed in it, and I can't imagine doing it any other way now. So I think for anyone listening, if business is what you want to do, it's almost like try to figure out how do you do it full time, because I don't think it's the same when you do it part time. It's just not, you don't have the same dedication and stuff like that, and stuff just happens. I don't know how that happened. I can't imagine how I did it with another job. I mean, just in my mind, I don't know how I did that, but it's
absolutely. Let me ask you, Oliver, in terms of job satisfaction, now that you're running your own business, do you feel that you have more job satisfaction today, or is it the same as when you were working for someone else in the corporate world?
Yeah, I think the question, like it's pretty obvious or intuitive, but it's definitely now. I think also, because we talk about job satisfaction, but it's also just life satisfaction. It's just, I feel more content, as you said. I'm in the same boat. No regrets. If you want to do something, as long as we can't just make anything. We can't make reckless decisions. But as long as you approach it properly, you plan it out, and I think you should do it. It's also good because like I know this is not about you. Like your boy, but your boy is doing really well. And you mentioned the really prestigious school, all of those things, and I think it's because of I'm a firm believer in this whole intergenerational wealth. And that's my thing in life now. It's like, how do you leave things in a better state for the next generation? And I think it starts with us, whatever that is. But it goes with your philosophy of dividend investing as well. It's like, you're building stuff over time and then you don't lose it. And I think for so many people, like their children are starting from scratch again. and then again. And I just don't think that's fair. So I love, I love this idea of like you just building on, like building over time. I think it's pretty cool.
Yeah, absolutely. I've had some clients who have taken the Simply Investing course, and they're already 65, 70 years old. And I'm thinking, that's kind of late for starting now. But when we've had the one-on-one client consultations, they said, you know what, it might be too late for me, but I'm going to leave something for my children so that they have, like you said, they can make the world a better place. They have a lot more options than I ever had. So that is something to consider, absolutely, to leave something for the next generation.
We probably should have said it at the beginning of the show, but this is you have to obviously check all of this with whoever your financial person is, but it's not like huge legal disclaimer around any of the figures and stuff like that. Just saying. But I know you say that really nicely in your in your content and stuff like that. So coming back to your like the space that you play in. So I want to go into the SaaS kind of part now. But I think even in the mastermind, like we meet up every month now. It used to be every 2 weeks. But I think about a few months ago, someone in the mastermind said, I eventually understand your business model, like in reference to, like Kanwal's business model. And I just want to articulate it and see if I got this right. So anyone can take your course, right? And they can understand your philosophy and your principles and apply that. Then you have the software where you do all of the legwork. Like the software just picks the stock, and then you can kind of model on what stocks you want to pick and how you do that. So it almost takes all of your principles and encapsulates that into a solution that's just done for you. Is that correct?
Yeah, that's absolutely correct. Yeah, it is. Now, if you don't mind, if we have a couple of minutes, I'm happy to share with you, with your audience, my exact philosophy. Right? There's no hidden secrets here. Okay. Right? And I love to share this information with everybody. And I'm going to go back to the beginning of the call where, what is it that I do? What's the elevator pitch? Right? So I'm teaching you how to invest, how to find quality stocks that are priced low. So there's two things I said in here: quality and price low. Another fancy word for price low is undervalued. So when a stock is undervalued, it's priced low. When it's overvalued, it's priced high. Okay, so how do you figure out that a stock is a quality stock? And how do you figure out that a stock is undervalued? Okay, so for that, I created the 12 rules of Simply Investing. And I cover those in the course. It takes about 2.5 hours. We go through all that with real life examples and everything. We're not going to take 2.5 hours today. We're going to take, if you don't mind, just to 3 minutes, right?
That's amazing.
So let's take a look at the 12 rules, okay? And a company has to pass all of the 12 rules before you invest in it. So if it fails even one rule, move on to something else. Move on to another company, okay? Rule number 1. Do you understand the product or service offered by the company? That's simple. Doesn't mean you need to be an expert or a genius to what the company is doing, but you got to be able to explain it to your grandmother or to a 12-year-old, right? How does McDonald's make money? Right? They serve food, they sell food, and they make a profit off of that.
And they have real estate.
Exactly. And they have real estate. How does Coca-Cola make money? They sell beverages and drinks. Right? They cost them this much to make, and they sell it for this much, and that's the profit. Right? Okay, so simple. You'd be surprised how many people buy stocks when it fails rule number 1. They don't have no idea what the company is doing. They just have a stock symbol, and they just put that in and order the stock. So don't do that. Rule number 2, will people still be using this product or service in 20 years? Okay, so think about the things that people still need to eat. People still need financial services, insurance, banking services, right? Doesn't matter what the future is going to look like. You're still going to need these things, right? So we want to invest in companies that are going to be around for a very long time. Rule number 3, does the company have a low-cost competitive advantage? So perfect example, I'll use Coca-Cola again. Coca-Cola is in over 160 countries worldwide. You can take that Coca-Cola logo anywhere in the world and show it to somebody and they know exactly what you're talking about, right? If you want to drink Coca-Cola, there's only one company that can give it to you, right? There's imitation brands, there's other brands out there, but if that's what you want, that's what you're going to go for. Same thing with McDonald's, right? If you want a Big Mac sandwich, there's only one company in the world that can give it to you. And people will cross the street, even though there's a burger restaurant right next to them, will cross the street to go to McDonald's and get what they want. Think about if you were to start a soft drink company today. Oliver, you're going to start a soft drink company today to compete with Coca-Cola. You would have to spend billions of dollars in advertising, and you still wouldn't get to where they are today. The company is over 125 years old. They have brand recognition, right? And they've been around for a very long time. So they have a competitive advantage, right? Rule number 4, is the company recession-proof? So let me ask you this question, same for the audience. If there's a chance that you may lose your job and we're in the middle of a recession, are you going to go out and buy a new car? Probably not.
Nope.
Are you going to go out and book an expensive vacation overseas with your family?
Nope.
Probably not. And just in those 2 examples, we don't invest in car companies, we don't invest in airlines. Okay? We saw what happened during COVID 2 years ago. GM cut the dividend to 0. They said, we're not doing well, we're not going to pay a dividend. And they cut it to 0. Boeing, one of the largest aircraft manufacturers in the world, cut the dividend to 0. Okay? So we want to make sure that what we're investing in is in companies that are recession-proof. So even if you lose your job, you still have to eat. You still have to brush your teeth. Right? You still need all these things. When you come home at night, you turn lights on, you're using electricity, right? And in the climates where I am, in Canada and northern parts of the US, in the winter, we have to heat our home. So you need these products and services, right? So that's rule number 4. Rule number 5, we're going to make sure that the company is profitable. So there's 2 parts to that. So part A and B. So part A is we're going to look at the company's earnings growth over the last 20 years. So if we graph it, we want to see the graph doing this. We want to see it going up. So for the audio listeners, I'm using my hand to make a line going up. We want to see the earnings over the last 20 years going up. We want to see at least 8% growth or more. If we see it doing this, coming down, forget it. Company fails, rule number 5A.
Cool.
If we see it doing this, and we see with some of the companies doing this, they make money, they lose money, they make money, they lose money, they make money, lose money. That's random, right? Believe it or not, there are companies today on the stock market that have an earnings, we call it the earnings per share, that's negative. So you'll see a number and you'll say, why is it negative? Why is it negative $3.59 a share? Well, that's because the company lost money, right? And we don't want to invest in that. Rule number 5B, we want to look at least in the last 20 years, we want to see at least 8 increases in the earnings. Okay. So anyway, rule number 6, we want to make sure that the 20-year average for the dividend growth is 8% or more. Again, we want to see the dividend going up, right? If the dividend is coming down every year, it's coming down every year. Don't invest in that stock. Company fails, rule number 6. Okay, rule number 7. What we look at is the payout ratio. So let me give you a quick example. If a company is earning $2 a share, okay, so the earnings per share is $2 profit, and they're paying the shareholders a dividend of $1, that's pretty good. That means it's a 50% payout ratio. So 50% of what the company made, they're sharing with you, the shareholder, and the other 50%, they're reinvesting it back into the business to grow the business. So that's good. Let me give you a worst case scenario. The company is earning $2 a share, okay, but they're paying a dividend of $3 to the shareholders.
Okay.
What's wrong with that?
Doing that?
They're borrowing money from someplace else to pay the shareholders.
Why would they do that?
They do. There's companies that do that. Today on the stock market, you can see hundreds of companies where the payout ratio is over 100%. Okay. And that's very quick. It's going to take you 10 seconds to look at that number, right? And you look at that number, if it's over 75%, it fails rule number 7.
Okay.
Like I said, it's not rocket science.
Mm.
This is very simple, but we're looking at simple things, but we want to make sure that our money is going to be safe, that we're investing in a profitable business. Rule number 8, the debt must be 70% or less. So I'm going to give you a quick example. Company A and company B, all things considered equal, they have the same dividend, 5% return, everything's earnings are the same, they're in the same industry. Company A has a debt of 12%. Company B has a debt of 496%. Which company do you invest in, A or B?
Definitely not the one that has lots of debt.
That's right. It's common sense, isn't it? Right? Because if you're carrying 500% debt, when the market crashes, you're going to have a hard time servicing that debt. And then now you're going to have to lay people off. You have to close factories. Your earnings is going to go down, and now you can't pay the dividend. Right? So we cut off the debt at 70%. Anything higher than 70%, company fails, rule number 8. Again, very simple to check. You go to Yahoo Finance, any web page where you get stock quotes, look at the debt and just compare that, right? Does that make sense so far, Oliver?
Yeah, it's perfect, actually.
Okay.
It's actually, as you said, it's like simple, like, and as you mentioned it, and you asked the, the rhetorical questions as well. It's just like anyone would say, yes, we want to do that. And that makes sense.
Exactly. Okay. Rule number 9. Has there been a recent dividend cut or a dividend reduction? Okay. So if the company was paying a dividend of $1 last year, and now they're paying me 25 cents, well, there's something going wrong here. Like, what's going on here, right? Should I be investing in this company? Should I buy more shares in the company? Probably not. Okay. The opposite, when the dividend goes up, is a vote of confidence from the company that they've looked at their numbers, they've crunched their numbers, they know that they can afford to pay a higher dividend to the shareholders, right? A company does not want to reduce its dividend. I know GM, I told you, just did recently during COVID. Boeing did the same thing. They don't want to do that. As soon as you announce a reduction or an elimination of the dividend, the stock price does this. The same day, stock price goes down.
Okay.
Right. So nobody wants that on their hands. Right. So companies, that's why I said in rule number 7, they will actually sometimes will borrow money from someplace else to pay the shareholders because they don't want to cut the dividend. So if we see a recent dividend cut, we avoid that company and we move on to something else. Okay. Rule number 10, does the company actively buy back shares? So I'm not going to get into a lot of details on that, but we'd cover that in the course. Share buybacks generally are a good thing for the shareholders because that means that there's going to be less shares outstanding. So the shares that you own are going to be worth more, and the price will creep up. Okay, so that's a good thing. Okay, rules number 1 to 10, we've covered them all. If a company passes all the first 10 rules, we know we have a quality company. Remember we said quality and undervalue. So we covered the first part.
Wow. So 10 rules just for the quality.
Quality, that's it. And you have to pass all 10. If you fail one, move on to something else. Okay, so that's the first 10. Rule number 11 is going to tell us if a company is undervalued or overvalued. Price low or price high, right? Everybody says buy low and sell high. How do you know when a stock is priced low? So that's what rule number 11 covers. It's in 3 parts, A, B, and C. So rule A, we're going to look at the PE ratio, which is the price to earnings ratio, 25 or less. Okay, if it's higher than that, forget it. There's companies today on the stock market where the PE ratio is 300, 400, 500. Okay, and there's analysts on the internet saying you should buy more stock.
That's amazing.
25 or less. Rule number B, the current dividend yield. We talked about that before, the current yield, which is the dividend divided by the share price. So if it's, let's say, 5%, so the current dividend yield must be higher than the company's average 20-year dividend yield. Okay. Again, I love talking about this. I could talk about this all day long, and we can get into the detail. Like, it takes about 15 minutes to sort of explain why that is true. For now, I'm going to ask you just to trust me, right? But in the course, I go through the building blocks to show you why this is the case. Okay, but we're going to skip that for today to save time. So rule 11B, we want to make sure that the current dividend yield is higher than the company's 20-year average dividend yield. Then you know the company is undervalued. Okay, this is the most important rule out of all the rules. If you want to save time, Oliver, you want to save, you don't want to go through all the other. If you're looking at a company, go straight to rule 11B. If it fails rule 11B, don't bother with the other rules.
Oh, wow. Okay.
Okay.
That's a good
again, I talk about that in the course. That's sort of the shortcut. Okay. Rule 11C, we're looking at the price to book value ratio. Okay. So the book value is what is the company worth today if we were to liquidate everything. So, you know, you look at a large company like, I don't know, Coca-Cola, right? They have so many factories, they have so much machinery, they have so many trucks. And so if we were to liquidate everything, how much would that be worth, right? So let's say the book value, I'm just going to make up a number. Let's say the book value for the company is $35 a share, okay? And the stock is trading at $36. That's pretty good. You're buying the company for what it's worth. What generally happens in the stock market is the book value is $35, but the stock price is $296.
Cool. Yeah.
That's crazy.
Yeah.
All things considered equal, assuming everything else is fine, imagine a stock had a book value of 35 and was trading at $21. And that happens. You will actually find sometimes stocks trading below book value. All things considered equal, that is an amazing deal.
Yeah.
Every stock that I've looked at that has, it's rare, but when that happens, you're looking at huge gains, massive gains. So we look at the PB ratio, must be 3 or less. Okay, we're down to the last rule. Okay, the last rule has nothing to do with looking at stock data, nothing to do with payout ratios and debt and numbers or anything. It has everything to do with you, the shareholder. So rule number 12 says, keep your emotions out of investing. And I know that's very hard to do. When you're talking about your money, it's very easy to get emotional about your money and to get attached to a stock or to panic when the stock goes down, right? So if you buy a stock today for $25 and tomorrow it goes down to 10, the immediate reaction people have is that they panic, right? And then they just sell it. And that's the worst time to sell. Is when the price is down. Now you've solidified your losses. But if you didn't do anything and you held on to the shares, maybe the $10 would go back to 12, could go to 30, go to 40 and 50 later on over time. But while you're waiting, you're going to get dividends. So just hold on to the shares and don't panic. We saw a lot of panic selling in the last 2 weeks with the stock market coming down. A lot of people panicked and just sold everything that they had.
And how do you track that in the software?
Okay, so now we get to the software. So out of the 12 rules, you'll see that 10 of them, rule number 5 to 11. So rule number 5 to 11 are quantitative, right? There's no gray area. It either passes or fails, right? Is a company recession proof? Well, that's gray area. You can argue one way or the other. Right? Is McDonald's recession proof? Okay, you can argue either way. But rule number 5 to 11 is what I call the SI criteria. So there's 10 of them, the 10 SI criteria. So the software application that I just built, it took 2 years to build. It was a lot of work. The software application applies the 10 SI criteria to all 6,000 stocks in the US and Canada every single night.
Yeah, it's amazing.
And so when you log into the application at any given day, you look up the stock. If you look up Coca-Cola or Walmart, it'll tell you immediately if the stock gets a 10 out of 10 or a 9 out of 10 or a 7 out of 10, and it highlights the failures. So you can actually see which of the rules it's failing and why. So that's what the software is doing. The first 4 rules, that's up to you. Right? Is it recession proof? Is it going to be around for 20 years? Right? So do you understand the company? So unfortunately, I could not figure out a way for now to build an AI, artificial intelligence, to be able to cover that for now.
And especially rule number 12 will be interesting to see how you model that.
That's right. That's entirely up to you.
Yeah. No, amazing. And I think, I think we brought across the concept quite nicely. And I think, I would like to put that all in the show notes but we, like, I also want to keep it relevant as well. And, the one question I want to ask is, so if you outside Canada and the US, I've seen lots of. I actually did research in prep for the show, and I was looking. In the UK, for instance, you can get a trading account and you can buy stock in Canada and the US. I'm assuming that's what you would recommend to anyone. If they wanted to trade or they wanted, that same basket of stocks, so just find a trading platform that will allow them to do that, and then they could still use your philosophy, the SI philosophy, as well as the software to be able to do that.
So there might be tax implications when you buy foreign stocks outside of your country. So I am not an expert in the tax laws, so you'd have to consider that before you do that. But yes, I do have clients from South Africa and the UK and all over the world, even in Australia, and in Germany and France, where they are buying US and Canadian stocks. So you'd have to open up a trading account that allows you to trade US and Canadian stocks. And then you could use the Simply Investing platform to make life easy for you, or you can take the course and apply it yourself. So the course just teaches you, and it gives you the tools. I give you the spreadsheets. Everything is in a Google Sheet. You can go in there, you plug in all the numbers, and then the Google Sheet will automatically apply the SI criteria, and it'll highlight the failures and the successes. So you could do that yourself, but it takes time to enter the data in and gather all the data for every stock. That's where the platform does it for you, because we do it for all 6,000 stocks. Now, but here's the other thing, Oliver, for your audience in South Africa and the UK, you could take the course and apply all of the Simply Investing principles to the local stocks in your country. And I do have clients who have done that in South Africa and in the UK, who have taken the course and then they just plug in all the data for their local stocks. And then you'll know if your local stock is undervalued or overvalued, and you'll know if it's a quality stock or not. And you can do it that way.
That's incredible. So I think so. The system is, and that's the beauty of it, is like, you can apply it wherever. I think you've taken a stand. It's a really cool strategy because that's the biggest markets in the world. But Northern America is just on those stocks. But I think whether you're in Malaysia, you mentioned Australia, South Africa, UK, you can use the principles and also the cause to be able to do that.
Yeah, absolutely. And I have looked at adding in international markets into the software. And that's entirely possible. Now that the framework is done and the platform is proven, and we've had it running and it works, we would just have to plug in to the international data, whether it's the UK market, the London Stock Exchange, or in South Africa, or even in Australia, and we can bring that data in. So it's something I'm considering, but it won't be for a little while, because I understand how much work is going to be involved in getting that done.
Okay, that sounds exciting. On that same trajectory though, so you're one of the, and I wanted to say, like when we joined the mastermind group, I was quite amazed that you didn't have a technical founder. And I know you said you had a comp science background, but the way you got that software developed and and to where it is right now, it's been an amazing journey. Just watching it in the mastermind group. So yeah, well done for that. And I think it's amazing that you're taking on clients. It's very, very, it's growing and all of that stuff. So yeah, very cool.
Yeah, awesome. Thank you. And it's been challenging, but I hope my story will inspire other people who are not software developers to consider it. Right? It's a lot of work, but I think I've shown that it's possible. Right? So if you have an idea, a great idea for a piece of software or an app, and you're not a developer, it's possible.
Yeah.
If you have any questions, send me an email. I'm happy to answer questions because I've gone through it for the last 2 years.
Yeah, I mean, and that's an amazing story, and I think obviously amazing world as well that we live in. And so we'll include all of your details in the show notes. So if anyone wants to contact you, they can do that. I do want to include the links to the course as well as the software because I think that would be amazing. But yeah, that was a really cool story. In terms of taking an idea, keeping with it, just every day doing something. I mean, I'm a firm believer in this as well. Actually, this episode ties with someone else I mentioned, I think in the mastermind group, Justin Spencer Young, about creating value. And I think that's, for me, business, that's what it's about. It's just about creating value, just doing something every single day, every single, week and month, and just moving the needle. And I think, I saw that in practice, with your journey. So yeah, that's a really cool story. I think that's a story in its own right, probably. But as you said, I mean, if anyone's interested, they can probably drop you a note. If you have a blog post on that, I think that would be a pretty cool blog post to have, detailing your story. But yeah, let's leave it there. I think we tried to give, all-rounded view on this. I think you brought in, and I really appreciate that. I think you delivered proper value in terms of the episode, in terms of giving that tangibly as well. Because as you could have easily said, no, just go buy my course, but you didn't, which I really, really appreciate. And I think anyone listening to it would appreciate. I think we made a real case for why the software exists and, why not just buy the course. I think that's pretty clear. I think you gave us a roadmap for possibly South Africa and the UK, which would be exciting. Yeah, but in terms of this topic, in terms of your journey, is there anything that you thought I should have asked you that I didn't?
Good question. I hadn't thought about that. I think we talked about how I started with the Simply Investing, how I left corporate, and you did ask me why I left corporate too. So we covered that as well. Yeah, I guess the only question was sort of what are the future plans? That's the only thing I can think of.
Yeah.
So what does the next 5 years look like? Do I want to turn this into like a 30-person corporation, or do I want to keep it as a single person, right, owner? So what do the future plans look like?
Yeah, I mean, if you can answer your own question, that will be amazing.
I knew that was coming. I knew it. So I always tell, the future is unknown, right? People ask me all the time, is the stock market going to crash this week, this month, or next year? When is that going to happen? And I say, listen, nobody can predict the future. Nobody knows what's going to happen. So in terms for me with the business for the next 5 years and beyond, I would actually prefer to keep it small. Having worked at Fortune 500 companies, I don't want to turn this into a 100-person company, because then I think I would just be back to having a job again, where I'm, I enjoy the freedom and the flexibility that the business allows, and I think I just want to get it to a point where I know that my family is well taken care of. Our future is well taken care of in case something happens to me or anybody else, or they get sick or anything, that financially the company, the family's fine and they'll be taken care of. So I think once I get to that point, I'm happy to keep Simply Investing small. For me, I'm passionate about this. I don't know if you can tell from my voice during our call here. I'm really passionate about this. So I just love teaching and showing people, okay, this is how you can take your money and grow it safely. This is the way to do it. So as long as I can keep doing that, I'm happy, right?
Okay.
So I'm happy to keep it just me, myself, and just keep the business going as is.
And I think that's been, I see those two different paradigms in the SaaS model or the world. It seems to be, either you're taking, the basic business and you're building it up, bigger, or you're keeping it to a level. And I think you're definitely living the dream. So, there's nothing wrong with that, as long as, so, it's a really cool 5-year strategy. I love it. I think I want to say, I forgot about it as we were wrapping up there, but it would be nice to take, the SI principles and also apply it to your own business as well. And I think that's why we had Justin Spencer Young on, as we spoke about like, getting an external person, evaluating your business. But if we take the business angle on this, I'm very, very keen on that idea. Is take those principles, like that you're advocating and apply to your own business as well and see, is your business going to be recession proof or COVID proof, and, will it survive, will it survive without, a team on? And I think if you can answer those questions for your own business, I mean, I think that's pretty amazing. And I think that's what I take out of your, your philosophy as well, is, looking at those principles and seeing how do I apply it. And I think because if you do that, then you're creating something of sustainable value as well, which is pretty amazing.
That's a great idea. I've never thought about that because I've spent the last 21 years evaluating other companies. But that's a fantastic idea to turn it around and to evaluate your own business. I like that.
Yeah. I think for any SaaS, I'm a business, I think it's probably worth doing it. We in the mastermind, we always spoke about risk factors, and it's normally always technical, but also on the business, like the true thing. And I think this is where the space where financial advisors start coming in, where they talk about, what happens if something happens to you? Like, how is Simply Investing going to be around? Who's going to take it over? All of those kind of things. We didn't speak about your brand as well, but you spoke about Coca-Cola. But I think the exciting news, you said it like in a few masterminds ago, you mentioned, you actually have the brand in, registered, the trademark, I mean, registered in the US, which is incredible. That's building that longevity part, and which is what people normally don't think about. So good for doing that.
It also, in addition to what you just said, it also, I believe it increases the value of your business, because if you ever wanted to sell the business, and that's always an option, right? In the future, if I wanted to sell Simply Investing, well, now you get the domain name, you get all the intellectual property, you get the software, and you get the trademark Simply Investing that comes with it. So that just makes it more valuable.
No, definitely.
That was what convinced me to get the trademark. Otherwise, I hadn't done it in the last 8 years. I said I didn't need it. But that's what convinced me to go ahead and apply for that.
No, I don't think many people think about that. You always hear about patents and patents, like with the bigger companies like Google and Apple. But I think that's a really good way that you can almost solidify your position, and have, as you said, something of value that if you wanted to sell, then you could say, actually, I do have this, and that makes my value even higher. But very cool stuff. I think let's leave it there. I really love this conversation. I think you over-delivered. I think it's really it'll be of value to anyone listening to it. And I think what you did was you kept it actionable and tangible and location independent, which is pretty amazing. Thanks very much for doing it.
Oh, thank you so much, Oliver. I had a great time and a great chatting with you. Appreciate it. Thank you for having me on.
Hey everyone, thanks for listening. As always, stay tuned and we'll speak to you in the next episode.